When you're investing in Knoxville, Tennessee, your capital improvements will wipe you out faster or feel like they're wiping you out faster than they do when you get a higher rent base like you would in a Southern California market. I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. Your real estate education is hugely important. I have 2 meetings a month specifically to help you with your real estate education. FIBI Pasadena, FIBI Pasadena. We meet here in Southern California. We've been meeting on Zoom, by the way, this whole last year, and we'll continue to meet on Zoom for a while, but we're going to bring back the in-person element of the meeting. Probably we're hoping soon, September, October of 2021. And then we're hoping to also keep the Zoom element or the virtual element of each meeting available. So for those of you who have started following us in the more national market versus the Southern California based market, I'm hoping that you guys will continue to want to come to our FIBI Pasadena meetings for the education. Yes, networking is also very helpful and good, and we will continue to encourage networking in the breakout rooms in the Pasadena meetings, as well as we will have, of course, physical networking in our rooms in Pasadena. So that's our hope. But your education is your definer of success. It may be your single most, maybe that's stating it too much. Maybe it's your single most definer of your success in real estate is your education level. The second, of course, is your network. You can't purchase a loan. You need to have a real estate agent. You need to have a wholesaler. You need to have access to units. Bruce Norris himself is the one who said, if you do not have a good acquisition system, you will not be successful in real estate investing. So that being said, the topic for today's educational show is investing in stabilized markets. What works? So stabilized markets are, you could say, the opposite of appreciating markets. Many of you, if you've been listening to the last several shows, know about the St. Louis Fed. That is FRED, F-R-E-D. If you type in FRED, F-R-E-D, housing chart, and the city that you're looking to invest in, you will get a chart that has a very distinct pattern to it. It will either be an appreciating market where literally it looks a little like a roller coaster. It goes up, it goes down, it goes up, it goes down. You'll see some lines that might even be appreciating by more than 45 degrees. If you're looking at a stabilized market, you will see a nice steady line across multiple recessions, or at least across recessions, that show a 20 to 30 degree angle in the line itself. That is an indicator of a stabilized market. Stabilized markets are generally less high demand cities. The price of the land underneath the actual improvement is less than you find in something like Los Angeles, San Francisco, New York, Chicago. Those are my favorite examples. And that means it is a different dynamic. Even timing the market is a different dynamic. I call it know the pony you're riding. If you're looking to invest in highly appreciating, depreciating markets, I call that your sprint, your racing pony. You're going from the bottom of the cycle to the top of the cycle. You are sprinting. You have an intentional goal for owning that property. And it used to be that rentals worked fine, but I would say not so great in Southern California for appreciating, depreciating markets. I would say flips work better because the title of this is what works. So if that's appreciating markets, what about stabilized markets? I've owned in Knoxville, Tennessee. I own in Indianapolis currently. I consider those to be more stabilized markets. There are multiples. There are more stabilized markets, I believe, in Southern California, especially if you're including suburbs, than there are highly cyclical markets. Why? People want to live in certain parts of the city. They want to live in downtown LA or close to LA. They want to live in Santa Monica. They want to live in San Francisco, close to Intel, where they work in that tech area. Or they want to live in San Jose because that's the new tech area. They want to live close to something that specifically pulls them in and creates a higher level of demand. Well, in Knoxville, Tennessee, there just isn't that same level of demand for specific areas. Even the university doesn't create that level of demand. Indianapolis, same thing. Not this, there are multiple industries with multiple different locations across Indianapolis, so there isn't that same distinct demand to have to be in downtown Indianapolis right next to X, Y, and Z. So what does that mean? It means that you literally have a 20 to 30-degree line going across recessions where the price of the real estate is not hugely affected by the recessions, the economic recessions that are coming and going that create compression and then create fear. The advantages of investing in that type of stabilized market is that generally rentals, single families and multi-units, work really well. You can do flipping, and I'll talk about that because the purpose of this conversation is what works. Rentals work. Rentals are purchased in these stabilized markets for cash flow and appreciation. So you get cash flow, maybe you get 5% cash on cash, 6, 8% cash on cash, very rarely above 10, but maybe somewhere between 5 to 8% cash on cash. That is what you're holding the property for, is a nice solid cash flow. You will get some appreciation, but you're really talking 3 to 5% a year. So you take the two together of your 3 to 8% cash and cash and some 3 to 5% appreciation, you put those two together and you get a solid return on your real estate. It's not dazzling. It's not sexy. As a matter of fact, it's almost downright boring. You buy it, you put a renter in, they leave, you put another renter in. Years later, maybe even decades later, you now have appreciated enough capital in it that you look to refinance out the capital that you have sitting idle in that building in order to buy another one and wait another decade. Okay. So, but it is stable and it works and it holds your capital and holds your principal and it doesn't go in these high cycles that you need to babysit. It works. What doesn't work? It's good than a cycle resistant, but it is very price sensitive. You increase your rents by $20, $30, $50 in that market, you will find people will move very quickly because of that increase. You do that in Southern California, San Francisco, New York, and other high appreciating markets where rents are just downright more expensive. $20, $50 of a change in rent is not going to be that meaningful, even when you're renting out to blue collars or mid-management. Whereas in Knoxville, Tennessee, I learned distinctly and personally that if I started to increase my rent by more than $20 a month, I actually would see higher vacancies. Price sensitive is a problem. So what do you do about that? Well, what you do about that is you don't intend to increase your rents hugely. You see, it has to do with, we think of it, at least I think of it, maybe others are smarter and they haven't made this mistake, but I have a tendency to think of it as an increase of $20 or $50. What's the difference between my Southern California units that I owned in Van Nuys and my Knoxville, Tennessee units? Why can't I increase $30 or $50 in Knoxville, Tennessee when I can do that in Van Nuys easily? It's because it's the percentage. The rents are lower. If my rent is $1,000 in Knoxville, Tennessee, and I increase it by $50, that's a 5% increase. If I increase it by $50 in my $2,000 a month rental here in Southern California, that's a 2.5% increase. You can see very quickly that $100 or $50 becomes very meaningful in a Knoxville, Tennessee, where it is not as meaningful in Los Angeles. So it's much more price sensitive. That price sensitive dynamic is important in stabilizing your tenants, but is also important when it comes to maintenance expenses. So even though I do encourage you to increase your rents at 3 to 5% or more per year, generally 3 to 5% in cities like Knoxville, Tennessee, being sensitive to that they are more price conscious and price sensitive than we are, I encourage you to do that, but also be aware that the amount of money you get in, that price sensitivity also means it's harder to accumulate enough capital to be able to manage major repairs. So if you have to replace a whole AC system and you're bringing in about $200 a month for each door, and that door, whether it's a single family or a multi-unit, that door now needs a new AC system that's going to cost you $3,500. How many months do you need to reserve at $3,500, sorry, at $200 a door to get $3,500 worth of rents accumulated? Well, $2,000 is 10 months. $4,000 is 20 months. So I have to reserve a year and a half to just shy of 2 years, that unit alone at $200 a month to be able to afford an air conditioner at $3,500. In Southern California, if I'm making money in Southern California, let's say I'm making the same amount of return on my dollar, right? I'm getting a 5% cash on cash, the same 5% cash on cash I get in Knoxville, Tennessee. 5% return means I'm probably going to be getting $400 to $500 a month. If I'm actually getting a cash return, which is a whole nother conversation, right? But if I'm getting that cash return in a higher rent market, then it takes me a year or less to be able to save for that air conditioning unit. So it means that when you're investing in Knoxville, Tennessee, your capital improvements will wipe you out faster or feel like they're wiping you out faster than they do when you get a higher rent base like you would in a Southern California market. If you can get that higher rent base, look at my previous video, you will find why I say if. Okay, so they're more price sensitive. They're price sensitive on rents, and they're more price sensitive when you have to repair something, when you have to repair a major system. The third thing is turnover. Turnover is always a pain. I have not discussed turnover in any of my previous this is a 4-video series. I have not discussed turnover in this 4-video series. Turnover is very important when it comes to multi-units, whether it's single family or multi-units, but it's very important to rental units, with single family or multi-units. Turnover ends up being very important because the more turnover you have, the more negativity you're looking at, because it's just like having a system go out and having to repair a system. Let's say you have somebody who leaves your unit in Knoxville, Tennessee, and it costs you $2,000 to turn that unit over. At $200 a month positive rent, it's at $2,000 to make that unit ready. It takes you 10 months of getting good solid rents on that unit before you even have $2,000 in reserve to be prepared for that person to move. So tenant loyalty becomes even more important in these high price sensitive areas than they do in Southern California areas where people come in and they go, and in theory, you can get more money, as in just more cushion, for the same amount of return, the same amount of cash on the dollar. Okay. So why? Because there's more dollars. Boils down to I have more dollars in my property in Southern California than I have in my properties in Knoxville, Tennessee. So I might be getting a 5% cash on cash return on my 100,000 in Knoxville, Tennessee, versus getting a 5% cash return on my 400,000 in a comparable property in Southern California. That's why it's more price sensitive. Everything is more compressed in these lower price point cities. Guess what? So is your dollar return is more compressed. Your return by percentage may look sexy, but your dollar return is compressed. Okay, you get it. So vacancies become very important. Managing vacancies in these stabilized markets become very important. Yes, it's important in more appreciating markets, but because you're holding it for cash, you're holding it for appreciation, your appreciation continues to happen whether you have a vacancy or not. The unit continues to appreciate. In Knoxville, Tennessee, when you have a vacant unit and you have low grades of appreciation, that vacancy can wipe out 10 months worth of cash flow. So it means that you really, for even more reasons, you do not want to be in the lower grade units, the Ds, the C or the D units in these markets. In general, have higher turnover. In general, they're more transient. In general, these tenants have a tendency to create more damage inside the units. Now you see what I'm talking about, right? Well, gee, if I don't want damage in the units because it takes money out of my pocket, which I'm getting a pretty good return on my investment, but I just don't have the dollars accumulating fast enough to manage that damage. Or I have people moving out and now I need to make the unit ready, which costs me money to do that. You don't want to be facing that damage and you don't want to be facing that turnover. And the B minus C, the B minus Bs and B pluses, they do not have that same level of turnover. Tenants are a little more stable. They're a little more white collar, a little less blue collar or gray collar or brown collar. Those are great. I don't have a problem with blue collar tenants, just so you know. Stabilized tenants are lovely, right? But in the Midwest, I've noticed that my stabilized tenants end up being in the B minus buildings, the B buildings. So in order to manage the fact that you have this compression of just cash that comes out of the building, I suggest you look at buying in B- instead of C or D. I've bought in C and Ds in Southern California, and I've been okay with it. Why? Because even those continue to appreciate. I'll buy a C or D in Southern California because I'm more likely to get positive cash on a lower grade of unit. Yes, I have more maintenance going out. Yes, it's a bigger trouble. Yes, I have more turnover. Yes, I end up having more tenant issues. It is true. I confess, but because the units, the building itself, single family or multi-units continue to appreciate as the market appreciates, even though it's more trouble, I'm still making money on my money. In Knoxville, Tennessee, I end up losing cash flow that I should be getting, because remember, I'm buying in the Midwest in order to gain cash flow and have it supplemented by appreciation, not primarily appreciation. And I lose that cash flow if I end up with difficult tenants and a high level of turnover and a higher level of damage. Okay, so that's rentals, multi-units, and single families in stabilized markets. Let's talk about flips. So I have flipped, you could say, in high appreciating markets and in stabilized markets. I flipped more in high appreciating than stabilized, so that's why I say you could say mostly the flipping I've done in stabilized markets is to make it ready for rent. But I then need to reanalyze, well, what is the current value of the property I have if I were selling it on the market? Here's what I have come up with. In Southern California, because I'm dealing with price per square foot going from, let's say, the bottom of a deferred maintenance price for a single family residence might be selling for $400 a square foot, but a finished product might be selling for $900 a square foot. I now have almost $400 a square foot room of appreciation and gain that I'm going to get, which just gives me more cash to play with. Same thousands, let's say it's 1,000 square feet over here, and now go over here and it's 1,000 square feet. I'm rehabbing a unit or a house, right? Rehabbing a house that's 1,000 square feet, but I purchased it at $50 a square foot. No, that's an exaggeration. I purchased it at $100 a square foot, and I'm going to resell it at $150 a square foot. So I now have $50 per square foot to work with. If I'm flipping $1,000 square feet in Southern California, and my margin is $400 a square foot, that is $400,000. If I'm flipping in Knoxville, Tennessee, or Indianapolis, and my margin, my increase from $100 a square foot to $150 a square foot, the $100 a square foot for deferred maintenance housing versus $150 for housing that is not considered deferred maintenance or rehabbed, and I have a $50 a square foot difference, that's $50,000 a month. What kind of rehab can I do with $400,000 profit versus rehab with $50,000 worth of profit? I'm talking about very different scopes of work. When my budget, my total differential is $5,000, how much am I going to be able to put into rehabbing that property? $25,000, $30,000, and then I'm losing money. How much can I put into a property where the differential is $400,000? Clearly, I can put $200,000 in, get a significant amount of rehab, and still sell the property at a significant increase in price. So do flips work in these more price sensitive markets because the appreciation is more flatline? Yeah, they do. They do. You have to accept that you need to be more sensitive, more careful about the choices of dollars you put in. Thank goodness cost of goods cost less, cabinets cost less, bathrooms cost less, labor costs less, but it's not significantly different. It's not so significantly different that you aren't having to be incredibly conscious and thoughtful about the flipping you're going to do when you're doing this in the more of the Midwest markets. It also means your purchase price becomes particularly important. Being able to purchase something off market, being able to purchase something that's less than $100 per square foot becomes very valuable. Being able to add square footage at less, with the construction cost can be less than your price per square foot for resale, becomes a very important conversation as well. So if you're going to flip in the Midwest, I want you to be very specific. There are lots of people I know who are successful in doing this. I could go down a list of 3 people on the top of my head right now who I know who are very successful at flipping in these lower margin markets, not lower margin percentage return, lower margin in that the actual cash, the actual dollar number is physically different and lower than what you have in these higher priced markets, right? Can you do it? Yes. Do you need to be judicious? Yes. Do you need to be on top of your team because of the holding costs? Yes. Those things become even more important, and the rehab usually is just not as deep. I've seen in Indianapolis in particular, I'll finish with this story. I've noticed I can buy a house for $45,000, put $75,000 in it. You would think $45,000 would leave me a lot of space. Put $75,000 in it, plus my finishes, and all of a sudden, I'm not making money on that property. Or there are people I see in Indianapolis who are buying properties. They're buying them at 40 to 70,000, and they are adding square footage, a second story. They're rewrapping the property and redoing the bottom floor, and they're making the money because they're taking the property from 45,000 to 100,000 from that range. They're purchasing it there and pushing it all the way up to 300,000. So I've noticed in these price sensitive markets, you either have a very slim budget or you have to truly knock it out of the park to move it from one comp level to a completely new comp level, which involves adding square footage, so it's now a new comp, and doing extensive rehab so that it is truly like new. Then you have moved your unit not from the bottom of the price range of a 3-bedroom, 2-bath, to the top of the price range of a 3-bedroom, 2-bath. You've moved it to a whole new comp level by making it a 5-bedroom, 4-bath. Then the property is truly worth more and you have more space for your rehab. But guess what? It also still costs more for your rehab. So just to be sensitive and to sum this up, just be sensitive and let's sum this up, which is in stabilized markets, you generally are purchasing for rentals, whether it's single family or multi-units. You're generally not focused on flips, especially if you're coming from out of state. The greatest value to you is probably in rentals, but can you do flips? Absolutely. I know lots of people who are living here in Southern California who have lots of investors that trust them who are doing flips out of state, but you must be prepared for the pricing that is out there and the compression on the pure dollar of what can get done. This is Christina Suter. Welcome to the Real Estate Breakthrough Show. I am so excited that you have been listening. Tune in next week for more information.